Hey everyone, and welcome. Today, we are going to break down a trading strategy that's built on one core idea: stop fighting the market and start following the big players. We've boiled down the source material into a super simple, step-by-step guide to trading with supply and demand. So let's start with a big question, right? How do you actually trade with the market instead of constantly feeling like you're swimming against the current? This is pretty much the most fundamental question for any trader, and the answer is the key to this entire strategy.
Well, the secret is actually pretty simple. You follow the smart money. Look, as retail traders, we're the small fish in a giant ocean. We don't have the kind of capital to move markets. But the large institutions, the banks, the hedge funds, they're the whales. So our goal is to spot the giant moves they make and just ride the wave they create. Okay, so what do these footprints from the big institutions actually look like on a price chart? As you're about to see, it all comes down to finding these specific areas where the balance between buying and selling gets completely and dramatically thrown off. First up, we've got something called a demand zone. Think of this as an area with a super rapid, powerful price explosion to the upside. You'll see it as a bunch of strong green candlesticks. Now, this isn't just random market noise. It's a huge signal that a large institution placed so many buy orders that they couldn't all get filled at once, leaving behind this little pocket of leftover demand that the price might just return to. And you guessed it, on the flip side, we have a supply zone. This is marked by a sharp, aggressive nosedive in price, which you'll see as a wall of strong red candlesticks. This tells us that the big players started unloading their positions right here, leaving a trail of unfilled sell orders. And that's what creates a potential ceiling for the price down the road.
So, when you put these two forces side by side, your job becomes crystal clear. You're a detective. Seriously, you're hunting for these clues, these powerful, unbalanced moves on the chart that signal where the market might just pivot next.
But, just spotting these zones is only the first piece of the puzzle. How do we turn this observation into a repeatable, rule-based trading plan that we can actually use? Well, that brings us to the three-step playbook. This framework has three simple parts. First, you spot the zone. Then, you wait for the price to come back to it. And finally, you manage the trade. The strategy itself is really straightforward, but the real challenge, and what separates successful traders from the rest, is having the discipline to follow these steps without, getting sidetracked. All right, step one is all about visual recognition. You're looking for that exact starting point of the aggressive move we just talked about. Once you see it, you literally draw a box or a rectangle around that area on your chart. This marks it as a potential supply or demand zone you need to watch. And now for what is, honestly, the most difficult and most important step of all: waiting. This is the filter that trips up most losing traders. The price returns to your perfectly drawn zone, and every single impulse in your body is screaming at you to jump in. But you can't. You cannot enter just because the price has arrived. You absolutely need more evidence. So what are we waiting for exactly? Well, the source material gives us two very specific confirmation signals. The first is a moving average crossover using a fast EMA like the 8 or 9 to signal a quick shift in momentum. The second is a powerful candlestick pattern, like a massive engulfing candle. You need to see at least one of these signals before you even have permission to think about taking the trade. Okay, so once you have your confirmation signal, you're finally ready for step 3, trade management. This is where you stop being a chart analyst and you become a risk manager. Before you even think about clicking that buy or sell button, you need to know exactly where you're getting out if you're wrong and where you plan to take your profits if you're right. The source material puts the logic for your stop loss perfectly. For a sell trade, your protective stop goes just above the supply zone itself, or maybe above the most recent peak. Think of this as your safety net. If the price breaks past this level, your whole reason for the trade is gone, and you get out with a small, managed loss. And what about your profit target? The answer is always found by looking left on your chart. Just scan back and find the next major level where the price struggled or reversed before. That becomes your logical exit point. You're not just guessing, you're aiming for the next predictable roadblock in the price's path. So, we have our playbook. But here's the thing, markets aren't static. They're constantly shifting between trending really strongly and just kind of chopping sideways. The great thing about this strategy is its versatility. It's not a one-trick pony. You can adapt your approach to whatever the market is doing right now. Here's how that works. In a choppy, sideways market, the price is basically bouncing between a floor and a ceiling. So you simply sell at the supply zone near the top and buy at the demand zone near the bottom.
But in a trending market, you trade with the momentum. So in an uptrend, you ignore the supply zones and you only look for demand zones to buy the dips. And in a downtrend, you ignore demand zones and look for supply zones to sell the rallies. And this brings us to our final and, frankly, the most important section of all, the human element. Because listen, you can have the most perfect technical strategy in the world, but without the right mindset, it is completely and utterly worthless. This quote just nails it, doesn't it? The fear of missing out, or FOMO, is a trader's absolute worst enemy. It's that voice in your head that makes you jump into trades recklessly without waiting for your rules to be met. The discipline to just sit on your hands and wait for the perfect setup, well, that's what this is all about. So what's the real cost of breaking the rules? The source gives us a perfect and painful example. Just imagine the price reaches a supply zone you've marked. You feel that FOMO kicking in, and you impatiently sell right away, totally ignoring the rule to wait for confirmation. And the source states the result bluntly. Price went up even further. Impatient traders got stopped out and lost a shit ton of money. That is the real-world cost of impatience. Your discipline is literally the only defense you have against this exact scenario. So let's wrap this all up with the key lessons. First, follow the smart money by identifying those zones of leftover orders. Second, stick to the 3-step playbook like glue. Spot, wait, and manage. Third, never ever ever enter a trade without confirmation. And finally, you have to understand that your real edge in the market isn't some secret indicator, it's your patience and your emotional control. And that really leaves us with one final question to chew on. We've spent all this time breaking down a powerful market strategy, but it's pretty clear the biggest obstacle isn't the chart, it's the person looking at it. So is the real strategy mastering the market, or is it mastering yourself?